Quality Commodities Inc. You got needs, we got products.
Welcome to our annual Board of Directors meeting. I'm Tracy Lee, and I'm the Chief Executive Officer.
I'm Jackie, I'm the Chief Operations Officer.
I'm Pamela Umpierrez, I'm the Chief Finance Officer.
I'm Rena Arredondo, I'm the Controller.
I'm Marlene Shimer, I'm the Vice President of Sales and Marketing.
I'm Erica Bojarquez, I'm the Vice President of Human Resources. The agenda for today's board meeting is as follows. We're going to open up with the introduction, go into the scope and purpose of our company, followed by our performance, highlighting our major achievements, going into our strategic recommendations. After that, we're going to go post-game eval, and we're going to close off with what we learned. So to introduce Quality Commodities Inc., you met our founders. Our company is a global corporation with 3 offices in America and 1 in Sereno. Our goal is to maintain a large market share while increasing our revenue every quarter. By achieving these aforementioned goals, we aim to be the most profitable company in the industry. We invest in our staff and products, and by keeping our expenses low, we're confident that we're on the right track to having the highest total net income in our industry. And now to go into the scope and purpose of our company. Our purpose is to manufacture sustainable, high-quality products at reasonable prices that our guests can afford and return a profit for our shareholders.
We're talking about the SWOT analysis. Our greatest strength is that we're the industry leaders in research and development. That allows us to produce the latest model the quickest, and it allows us to gain market share because we're releasing the model before everybody else. Another one of our strengths is that we invest a lot of money into employee training and development. That allows us to retain our employees and to increase production. One of our other strengths is that we provide competitive compensation relative to the rest of the industry. Our last strength is that we have the capacity to produce high volume units compared to the rest of the companies. This allows us to meet the demand of our customers, and it allows us to retain our market share. For our weakness, one of our biggest weaknesses is that we have low production capacity to meet the demands for year 7. Based on our forecast, we do not have any inventory to meet demand in year 7. We're probably going to stock out if we don't increase our lines or increase overtime. One of our other weaknesses is that we have a high unit production cost. This is due to our increased spending into R&D, and also because we always try to introduce the newest model. So every time we introduce a new model, our unit production cost increases by a little bit. So our last weakness is cost control. And that's due to the fact that R&D expenses are always increasing, and they tend to be unpredictable, which in turn reduces our net income. All right, so one of our greatest opportunities right now is to continue to invest into research and development. This allows us to keep in line with our strategy, which is to produce the latest models and to introduce them faster than everybody else. Another one of our opportunities is to expand our production into new markets. So currently we're only producing at M1 and Sereno. If we expand our plant in Sereno, that allows us to increase our capacity and to lower our expenses relative to introducing a new plant in M1. Our last opportunity is that since GDP is growing in America, this translates to more sales in America, so we can capitalize on that by investing more money into our advertisement or increasing salespeople for America. Okay, so for threats, one of our biggest threats right now is that the exchange rate in Sereno is increasing. What's happening is that due to the inflation, our money is worth less in Sereno, which is causing us to lose money by producing in Sereno. One of our other threats is that our competitors' prices are very competitive relative to ours, which means that customers can shift from our company to their company relatively easy if they base it on price. And our last threat is that we can't predict changes in consumer preference, which affects us because we're always trying to roll out a newer model. And if we don't know what customer preferences are, then we can't allocate our models towards what the consumer wants.
So now I'll talk about our performance targets for the year. So for both year 5 and year 6, we made predictions on these 6 criteria that you see up here. We made predictions on our return on assets, our return on equity, our market share, our stock price, our unit production costs, and our total net income. And as you can see here, it breaks down our generalizations of what the targets that we set for year 5. our targets and our actual, and as well as for year 6. So just to give you a generalization for our whole year, for year 5, we actually ended up surpassing our targets marked for our return on assets, return on equity, stock price, and total net income. We did, however, see a slight decrease in market share by about 0.15%. But overall, we did not lose our majority domination in our market share. And we also had a lower than expected unit production cost. And then for year 6, we actually did not meet the targets that we set for ourselves. We actually came in lower than expected on our ROA, our ROE, our stock price, and our total net income. But what we did notice is that we actually saw an increase in our market share. And we actually came out on top and dominated the market once again. And for our UPC, it went up by about 6 cents, but we pretty much maintained a pretty steady UPC cost through into year 6 as well. And next, we're going to go over our industry comparison of year 5. And this, in a sense, it recaps our totals for all these 6 factors, but it also compares our numbers to our competitors in the industry. What you'll notice here is for year 5, one of our best years is that we actually achieved above industry averages throughout all 6 factors. And then there's also been an industry growth overall in ROA and ROE. And market share also increased in competition because if you notice, our market share remained the same, but company 2 actually dropped about 2% in market share, but all other companies, market 3, 4, and 5, actually increased in market share. So year 5 was actually a pretty competitive year in terms of competing for market share, but we still managed to hold on to our market share. And another thing that we see here is that there was constant gains throughout each factor. Our stock price rose up, but we managed to still keep our UPC low, and we're still in line, well, not so much in line with UPC because our UPC is always higher than market, but we do not compete on price, so that's expected from our company. But aside from that, we're pretty much in line and above the industry averages. More in-depth look at the industry overview for year 5. And as you can see here, it's a little more prominent if you look at it in graph form. You can see that we actually ranked 2nd in all 6 factors in terms of ROE, ROA, and then market share. Market share is the one place that we actually are dominating in. So you'll notice the green line right here. You'll see that we're a little higher than the rest of the companies. But aside from that, we're pretty much consistently 2nd to the highest. The only person that we're actually following behind is on company 4. So it's actually a pretty good year for us. Our total net income actually was a lot higher than we expected at $3 million, and we actually anticipated a $2 million net income for the year. But we did fall behind company 4, as you can see right there. They're actually about at $4 million. But in general, yeah, we had a pretty good year, and we hope that this momentum continues into year 6. And here we have the industry comparison for year 6. Here we actually saw a not as high year for our company because we actually noticed that our margins were actually below industry averages for Quality Commodities Inc. We actually hit, our numbers were about half of what it was the year before in year 5. And if you look at the graph here, we also noticed that all our margins are actually about a lot lower than the industry average. But a good thing to note is that there has been a decrease in industry market share. All the competitors decreased in market share because we actually gained all the market share they lost, and our market share actually jumped up to about almost 27%. And then we also noticed that our stock price fell. Our UPC remained relatively the same, but we did have a pretty big decrease in our total net income. And our main thing for that is that we didn't account for such a great difference in inflation in Sereno, in which we have one of our production plants in. And we also were one of the companies that did not decrease in R&D spending. All the companies relative to us started relatively decreasing their R&D spending, but since our plan is always to consistently have the latest models, we actually maintained and actually increased our spending as we anticipate to have a new model by the end of the year. And here's a more in-depth look in our year 6 overview. And as you can see from this, like I mentioned earlier, this year we actually saw a little bit of a flip from our first year. Whereas our year 5 we ranked second to the highest in terms of all these factors, this year we actually ranked second to the lowest. It has to do with the fact that our expenses did increase, as we mentioned earlier. We have been increasing in our R&D, and we have been increasing in our training as well to keep up with the production demands that we have been gaining because we have had such a large increase in our market share. So you'll notice here that the blue margins here for our return on assets were one of the lowest, and that's the same can be said for our ROE. The only thing that's been consistently high, of course, is our market share. Our stock price fell as well, and our total net income actually fell as well. So this is just a general overview of the year.
Now I'm going to be talking about the functional strategy for salespeople. We strive to retain our staff. That's why we try to match it closely with demand. So the expected pretty closely matched the actual for hiring, except for Sereno was a bit lower than we expected, and that was because of a decreased demand, which we could see because the GDP dropped from 130.94 at the beginning of year 6 and ended at the end of the year at 103.87. And we also had a strong commitment to cut costs, and so in line with that, we only had 2 raises for the year, for the beginning of year 5 and the beginning of year 6, respectively. It was 3,183, and then only an increase up to 3,278. And the commissions also, because they're both variable expenses, they were slightly under planned as we decided to cut costs even more. Moving on, now we're going to be talking about the functional strategy for products. The product price, it was lower in 2015 and higher in 2016. This is because in 2015 we were focused on gaining more market share, and then as we gained that market share in 2016 we started to struggle with meeting the demand, even with maxing out our production capacity. So as a result, for advertising, the reverse was true. In the beginning it was higher in 2015 as we were trying to gain more market share, and then in 2016, in an attempt to reduce sales, we decided to lower it. And the unit sales, well, usually we try to, let's see, they were lower than expected. We usually overestimate them because we always try to make sure that we're never going to stock out. So in general, we see that we do usually overestimate them, so that was expected. Alright, finally we're going to be talking about the actual versus plan numbers for operations and product management. For many of our variable expenses, we did see that they were lower than expected, and the same happened with R&D. In an attempt to cut costs, we decided to lower those as well. And in addition, over time we learned that it didn't take as much money to get the new model as we had initially thought, so that was also part of our decision to lower R&D. Training expense, there was a lot of variability. Sometimes it was lower, sometimes it matched, and sometimes it was over what we expected. And that's because that was one of those variable expenses where we could decide, what we wanted to change to meet demand, and so that's why we saw that variability there. And the beginning inventory, it was higher than expected. This was also due to our focus on making sure that we don't stock out, so we usually ended up with more inventory than we thought. Storage expense, it was reduced, although at the very end of year 6 we saw a very high expense of 138 over our expected 97. And production was about as expected. We had to max out our production, so generally it matched what we expected, 12 first shifts and 6 second shifts.
The variance analysis for the income statement payments are shown as greater than 25%, which are the value-added tax, storage expenses, operating profit loss, net profit loss income before tax, net profit loss after tax. So first off, the value after tax is our value-added tax was lower than expected because we were able to pass on these taxes to our end consumers. Even though our sales were high, we did not make as much profit because we used our prices that were not adjusted in inflation. Next, we have storage expense. Storage expense is, since our strategy involved having the biggest market share, we had to increase our production, making our ending inventory to be high, and inventory left on hand caused us to incur storage costs. Next, we have operating profit and loss. Unfortunately, we were not profitable during the last 2 quarters of the year for year 6 because our production cost in Sereno was higher than expected. Our company did not adjust our product price accordingly. This affected our profitability and it forced us to record a loss. Next, we have new profit loss income before tax, and this was due to our profits not being as high as expected. Our income tax were lower than forecasted. For the net profit loss after tax, even though we had lost less money on taxes, we were still not as profitable.
I will be talking about the variances in our balance sheet from our forecasted to our actual. Our forecasted balance, cash balance was lower than we expected due to our stock repurchase. Since the stock price was increasing with time, it made repurchasing stocks more expensive than we expected. Since a lot of our sales were done on our foreign subsidiary, it made our cash collection much lower. Now, another differences was coming from our time certificate of deposit. We did not invest as much as we expected because we decided to utilize any extra cash to buy back stocks and bonds. Also, the rate of return on certificate of deposits were starting to decrease, making it not very profitable to invest on this. Our inventory also showed variances because we ended up having more inventory on hand than we expected. This is due to our increase in production in America and Sereno. We wanted to make sure we did not run out of inventory so that our customers will have our products readily available at any time. Also, our tax payables were not as high as we expected due to our revenue or profits not being as high as well. Now, on our bonds outstanding, we were expecting to have lower bonds by the end of year 6, but we ended up having 2 million bonds. We felt like 2 million was a comfortable level for us and decided to repurchase stocks instead. Our accumulated earnings, unfortunately, our accumulated earnings were lower than expected because we did not manage to be as profitable. Our profits were in by our expenses and for not adjusting our product price due to the inflation increase. Our accumulated foreign currency adjustment, we actually anticipated our foreign currency adjustment to be higher, but it actually ended up being in our favor. Now we're moving into what we have learned. As a group, we learned that we should have adjusted our prices in our foreign markets to account for inflation, and our management should have been more proactive in this area, which caused us to generate losses instead of profits. Also, we should have expanded our production capacity in Sereno early on instead of relying on overtime. When we originally just expanded 4 lines in Sereno, but we realized that we should have opened up 6 lines right from the beginning. Also, we learned that we should have planned our production in areas where material and labor are more affordable. In other words, we should have added more additions in Sereno instead of Merica, like we did. Also, we should have taken out or borrow money using issuing stocks instead of bonds, because that will have helped us cut our interest expense, making our profits higher.